Hey everyone, Scott Reinhardt here, and this week we are continuing to talk about IRAs and how you can take advantage of them between now and the tax deadline of April 15th. The current tax deadline, although there's been some rumors that they might extend it like they did last year, so we'll see about that. But specifically, today we're going to talk about a spousal IRA and a few other tips and tricks on how to take advantage of those IRAs before the April 15th deadline. Now remember, I'm just talking about the deadline for 2020 tax year. You have all of this year to take advantage of 2021. So we're specifically talking about 2020 with this video. So in the past, we've talked about to take advantage of an IRA, an individual retirement account, you have to have earned income. You have to have made money through work. You can't just have investment income. You can't just have Social Security. So, for example, let's say you're married and one of you's retired, the other one's not, and you made over $14,000. You're over 50 years old, so the max per IRA is $7,000 per year. Remember, it's $6,000, extra $1,000 if you are over 50 years old. Now, since one of you made over $14,000, you can contribute $7,000 in your name and $7,000 in your spouse's name. So you get to take advantage of the fact that one of you had earned income over the $14,000. Now, if you only made, let's say one of you just works part-time, you're both retired, but one of you works part-time, just has kind of a side job. Well, let's say you only made $10,000. If you want to, you can contribute $7,000 to one, $3,000 for the other. So take advantage of the spousal IRA. It doesn't just have to be that whoever made the earned income that you can only contribute to an IRA in their name. You can do it for both spouses using the spousal IRA concept. Now, you might be saying, Scott, I don't have $7,000 or $14,000 laying around to put into an IRA. So let's talk about some ways that you can try to fund these IRAs even if you don't have the cash flow to get it done between now and April 15th. Some of you may have accounts out there that are just non-retirement accounts. We call them non-qualified accounts. You might see them on your statements as individual accounts or joint accounts, or sometimes they're listed as brokerage accounts. Just depends on where the money's at. Well, what if you were to sell some of those investments, preferably taking advantage of either a capital gain or capital loss, and move it into the IRA before the deadline? You can do that. And it's especially helpful if you do it to where maybe you're offsetting some gains, offsetting some dividends, or maybe you need to take some gains to offset some losses. So there's possible you can get a double tax impact. So this is just using money that you already have invested and just moving it into either a Roth or a traditional IRA and just taking advantage of the extra tax breaks, the extra tax advantages that the IRAs provide. And I love the idea of being able to strategically sell some of those investments, either at a capital loss to offset the gains or taking a gain to offset some losses, and then you just put it in the IRA, and if you want to, you can just buy back the same investment, or if you want to put it into something better, you can do that too. But you get that tax break, whether it's going into the Roth or the traditional. Last week we talked about traditional versus Roth, so I'm not going to go into that in detail in this video. Go back, check out that video from a couple weeks ago. But I do want to give you an example. Let's say you are married and you're both 65 and you retired in 2020. Let's say you retired midway through the year, but you still had income that pushed you up into the 22% tax bracket. Just for simple math, I'm going to say you had $94,000 in taxable income in 2020 when you add it all up and then take off your deductions. Well, let's say you were to contribute $14,000 between now and when you file your taxes, or between now and April 15th. That $14,000 would shrink that $94,000 taxable income down to $80,000. So that's a big number, because at about $80,000, that's where the 22% tax bracket comes into play. Below $80,000 in taxable income is 12%. So in this example, you contribute $14,000 to your IRA and your spouse's IRA, $7,000 each. You've lowered your taxable income down to $80,000, and that saved you $3,080 in taxes minimum. Now, you might be saying, well, yeah, that's great. I'm saving $3,000 now, but what's it going to cost me later when I take it out? Well, it's possible that now your income in 2021 and beyond is going to be firmly in that 12% bracket. So even when you draw that money out that you just put in, it's going to be taxed at 12%. So you just saved yourself 10% in taxes with that one simple move, which in this case is $1,400. So I hope this helped. Hope you learned a little bit of something. If you did, please like this video, subscribe to our Carlson Financial channel so that you get these videos as soon as they come out. Go check us out at carlsonfinancial.com. Over in Carl's Corner, you can see all of our past videos on a lot of different topics, and you'll continue to see them as we post them there. So if you're afraid that you're not taking advantage of the tax code in the way that you can be to save yourself some of your hard-earned money, give us a call, 844-CARLSON, set an appointment with an advisor so that we can go over your tax plan and figure out how we can save you potentially thousands of dollars over the course of your retirement. Otherwise, you can check us out at carlsonfinancial.com. Thanks, and have a good rest of your day.